The situation in China is getting worse day by day. With the debt crisis unfolding, Chinese citizens are losing faith in their own banks. This is creating panic in the markets, with investors trying to get out while they still can. It's even gotten so bad that China has started limiting the amount of money its citizens can withdraw from ATMs. So what exactly is happening in China right now? And how much trouble is this country really in? Stay tuned to find out. But before we start, as usual, please support us by leaving a like. Without further ado, let's get right into it. We last talked about China's problems a few weeks ago when we published a video explaining why the world should be worried about China's debt crisis. The main takeaway from that video was that Evergrande Group, one of China's largest real estate companies, couldn't pay its debts. The problem is that Evergrande is just the tip of the iceberg. There are more than 60,000 other property development companies in China that have taken on billions in debt over the years. A lot of these companies built too many properties in anticipation of China's economic growth continuing to expand year after year. But as we saw, that's not the case anymore. China's economy isn't growing like it used to. In fact, it actually shrank in the second quarter of 2022 by 2.6%. So all of these companies that expanded their businesses based on the expectation that China would continue to grow are left with no buyers. They don't have enough cash flow to keep their operations going, and they're stuck with tens of trillions in debt that they simply cannot repay. This is the basic situation in China right now. And if you thought that the Chinese government would step in and help out these struggling companies, then you'd be wrong. You see, China's government follows a policy known as "let them fail." What this means is that the Chinese government will allow failing companies to go bankrupt instead of helping them out. The reason for this is because the government wants to get rid of companies that are inefficient and unproductive, and they want to force those who are left standing to become more competitive. Of course, this is easier said than done, especially in a country like China, where the entire economy is heavily reliant on exports. You see, Chinese companies export a lot of goods to the United States, Europe, and the rest of Asia. This is why China has been able to grow so fast over the past few decades. However, there's a big problem with relying on exporting goods for economic growth. If the countries you export your goods to stop buying your products, then you'll have an issue. And that's exactly what's happening. China has been experiencing slower than expected growth for quite some time now, but that's nothing new. What is concerning is that foreign companies are starting to scale back on their orders. One of the most obvious reasons for this is rising geopolitical tensions. For example, as we covered in our previous video, the U.S. has been pressuring countries around the world to decouple from China. Because of this, many companies are beginning to look elsewhere to manufacture their products. Another major concern is that wages in China have risen significantly over the past couple of years. In fact, wages in China have doubled since 2014, which makes it harder for Chinese companies to remain competitive. After all, a higher cost of labor means higher production costs, which means higher prices. And if you're a price-sensitive customer, then you're not going to choose a product made in China. Now, even though this might seem like good news for Chinese companies because it means they could raise prices and increase their profit margins, that's not the case. You see, for Chinese companies to remain competitive, they need to lower their prices so that they can sell more products. Sure, they could try raising their prices, but then they won't be able to compete with companies from other countries such as Vietnam or India. This is why China needs its economy to continue growing. If its economy stops growing or starts shrinking, then Chinese companies won't be able to compete on a global scale. And this will cause even more problems for China. And the worst part is that this is happening at the same time that China's population is aging. Just listen to this. By 2030, 22% of China's population will be over the age of 60. And by 2050, that number will rise to 35%. To put into perspective, in the United States, only 16% of the population is currently over the age of 60. Now, you might think that this isn't a big deal, but it actually is. You see, the majority of people over the age of 60 are not contributing members of society. They're either retired or semi-retired. This means that China will have fewer people working in its factories and producing goods for export. So China's economy is facing a lot of headwinds right now. Not only is foreign demand for Chinese goods declining, but wages are rising and its population is aging. These are all factors that are working against China and making it harder for its companies to stay competitive. So how is China dealing with all of these issues? Well, they're trying everything they can think of. Recently, the Chinese government announced that it would be cutting interest rates to boost lending and economic activity. They're also investing more money into infrastructure projects, and they're trying to encourage their citizens to have more children. But whether or not these measures will work remains to be seen. As all of this is happening, the U.S. and Europe are joining forces to defeat China once and for all. At the end of June, the U.S., EU, India, South Korea, Japan, Australia, and the UK released a joint statement announcing that they would be launching a new trade agreement called the Indo-Pacific Economic Framework. According to the leaders of these countries, the goal of the IPF is to improve supply chains and reduce tariffs among member nations. However, it doesn't take a genius to figure out that this agreement is an effort to counter China's growing influence in the region. Now, this isn't the first time that Western countries have tried to contain China's growth. Back in the early 1980s, the U.S. tried to prevent China from becoming a major player in the global economy by blocking its access to advanced technologies. However, this didn't work out too well because China found a way around it by simply developing the technologies themselves. This time, Western countries are hoping that they can use economic sanctions and trade agreements to prevent China from becoming a dominant force. We'll have to wait and see if this strategy works any better. Now, even though China has a lot of challenges ahead of it, we don't think that it will collapse anytime soon. Yes, its economy is slowing down, and yes, it has a lot of debt, but it also has a lot of strengths. China has a large and young population, which means that it has a lot of workers who are able to produce goods at a low cost. It also has a massive infrastructure, which allows it to move goods quickly and efficiently. Finally, China is a very innovative country, which means that it can develop new technologies that will make it more competitive. All things considered, we don't think that China will collapse anytime soon. However, we do think that it will experience a period of slower growth. This could last for several years, but eventually we think China will be able to get back on track. In the meantime, though, we think there are better investment opportunities elsewhere. The U.S. and Europe are still recovering from the pandemic, which means that there's a lot of pent-up demand for goods and services. Additionally, both the U.S. and Europe have very supportive monetary policies, which is helping to fuel economic growth. Finally, both the U.S. and Europe have a lot of innovation, which means that there are plenty of opportunities for investors to take advantage of. All things considered, we think the U.S. and Europe offer better investment opportunities than China. Of course, this is just our opinion, and not financial advice. Thank you for watching and subscribing. Until next time.